Hey folks, and welcome back to the channel. For our new viewers out there, hello, welcome. My name is John of John's Finance Tips. In today's video, I am going over with you 6 of the highest paying dividend ETFs in the marketplace. Now, as a quick reminder, an ETF or an exchange traded fund, you can think of like a basket of securities. They could hold stocks or they could hold bonds. However, unlike just investing in a single stock or a single bond where your risk position is so highly concentrated, an ETF allows you to de-risk your position in a way by being able to offer broader exposure to, say, a particular industry or a particular index that it tracks. A small ask that I have is, as we go through the list, comment down below what you notice about risk as well as cost. In a last order of housekeeping, folks, this is not financial advice or guidance. This video is purely for education and entertainment purposes only. All investing carries risk. Be sure to do your due diligence before you invest. The first fund on the list is the Schwab US Dividend Equity ETF, or SCHD. This ETF tracks the Dow Jones US Dividend 100 Index. This index is comprised of 100 stocks that are selected based on 4 fundamental characteristics: cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate. And all the companies on the list have paid a dividend for 10 consecutive years. And this fund is comprised of a good number of large cap value stocks. You probably would have heard a lot of these companies, but some examples are Verizon, Home Depot, as well as Lockheed Martin. Next up, average returns. Over a 10-year period, this ETF saw a return of 13.35%, which is pretty respectable if we compare this against VOO, which is an ETF that tracks the S&P 500. Over a 10-year period, VOO saw a return of 12.52%. And as for dividend, it is paid out quarterly. Its current dividend yield is 3.32%. If we compare that to the dividend payout from VOO, that's only 1.52%. And from a cost perspective, it has an expense ratio of 0.06%, which means for every $10,000 you invest, you will pay a $6 fee. And next we have risk profile. I put this fund at a square 2 out of 5. Largely because as we look at a lot of these companies, these are blue chip players and they've shown a consistent record of paying dividends over the past 10 years. The second fund on the list is the Energy Select Sector Spider Fund, or XLE. This fund tracks the Energy Select Sector Index, and this index tracks the energy sector of the S&P 500 with a heavy weighting from many of the world's major oil producers. And a good number of the companies here I'd categorize as large cap with a blend of value as well as growth. Some of the top holdings are companies like ExxonMobil as well as Chevron, and some of the companies that might not be as familiar, such as ConocoPhillips and Marathon Petroleum. Next, let's look at average returns. So at the 10-year, we see a return of 5.4%. And as for dividends, this pays quarterly, and its dividend yield is 3.58%. Now let's explore costs. This has an expense ratio of 0.1%, which means for every $10,000 that you invest, you will pay a fee of $10. Next, we'll move on to risks. Obviously, with an ETF that is tracking the energy sector, you're gonna be very concentrated with a lot of exposure to energy. And the issue that I have with XLE is the fact that you have a very high concentration in 2 stocks, namely Exxon as well as Chevron. If those companies have issues, well, you're gonna be impacted by that. However, if we evaluate the risk of this fund compared to some of its peers in the energy sector, I would say this is actually slightly below average as far as risks. The third fund we have on the list is the iShares iBoxx High Yield Corporate Bond ETF, or HYG. This ETF invests in high yield corporate bonds, which is actually another name for junk bonds, but not junk in that they're useless or junk in the stuff that you got hanging in the trunk. Kidding. But rather, junk bonds is a slang for bonds that are associated to companies with slightly more risk and that bonds with a rating that aren't quite investment grade. However, for taking on a higher risk, you are rewarded with a higher yield. Next, we'll look at composition. So some of the names you might recognize here are American Airlines as well as Caesars Entertainment. Average returns. The 10-year return on this ETF is 3.21%. And as for dividends, they pay out monthly, and its dividend yield is a whopping 5.13%. The cost, or the expense ratio of the fund, is 0.48, which means for every $10,000 that you invest, you're gonna pay $48. Now let's talk about risks to consider. Keep in mind, this ETF is investing in high yield corporate bonds, or I guess more colloquially known as junk bonds. And the reason they are high yield is because of the fact that these companies might be at greater risk of going under or not being able to pay back the money that they borrowed. However, just by way of having junk bonds doesn't mean that they're gonna go bankrupt tomorrow. For example, companies like American Airlines or Ford Motor Company have double B bond ratings, meaning they would be considered junk bonds. So we kind of have to put that into context when we think about high yield corporate ETFs. And when we compare HYG to its industry peers from a risk profile perspective, I'd say this is an average amount of risk here as a 3 out of 5. The fourth fund we have on the list is the iShares International Select Dividend ETF, or IDV. This fund is comprised of relatively high dividend paying equities in non-US developed markets. As for composition, you likely have not heard of many of these companies unless you primarily invest overseas, companies such as Rio Tinto and British American Tobacco. Next up, we have average returns. So the 10-year return is 3.76%. And as for dividend, it is paid out quarterly at a whopping 6.86%. Now on to cost of the fund. It has an expense ratio of 0.49%, which means for every $10,000 you invest, you're gonna pay $49. I'd say when we look at broadly these dividend ETFs, coming in at below 0.5 is what we wanna aim for. If we can get under 0.1 is solid. So for me, because it's coming in at under that 0.5 threshold, it's acceptable, but it's certainly getting up there. As for risks, I would say this is above average. When you start chasing high dividend yield, one thing you want to be careful of is exactly how dividend yield is calculated. And that formula is the dividend distribution over the share price, which means if a company's share price were to go down, its relative dividend yield might go up. Now, I'm not saying that's what's happening in this case, but we do want to be cognizant of what happens when we start chasing higher dividend yield. In addition, taking a look at its 10-year historic, it's very much below the average of what you might get, say, as a standard S&P 500 index fund. The fourth fund on the list is the JPMorgan Equity Premium Income ETF, or JEPI, JP. One of those. The fund is going to primarily invest in S&P 500 stocks that are going to exhibit low volatility and value characteristics, and sell options on those stocks to generate additional income. And so if I look at the holdings, I would say largely this is gonna be large cap with a blend of value as well as growth stocks. As for returns, this fund hasn't been around for 10 years, so we're gonna look at since inception. And since inception, it's up around 9.71%, which is pretty solid. This fund pays a dividend monthly, and its dividend yield is 11.49%. The cost of the fund, it has a 0.35% expense ratio, meaning for every $10,000 that you invest, it will cost you $35 in fees. Now, what are some risks to consider? Well, given that a huge strategy of this fund is active management, that right there is risk. Do you trust and believe who the fund managers are? In the grand scheme of investing, for me, no, I don't really like active management. I'm a guy who subscribes to low-cost, broad-based market index fund. However, this is a video on high-yield dividend ETFs, and JEPI, or JEPI, certainly is a high-yield dividend, and it makes the cut. But I really want you guys to consider, do you want active management involved in your overall investment strategy? Now, coming in an expense ratio of under 0.5, I'm okay with, but again, when I look at my funds, I'm trying to target below 0.1%. The other risk you might want to consider is that there's not a lot of historic data because this fund was launched just 2 years ago. So you really want to keep an eye on it. But of course, past performance is not indicative of future returns. Totally get that, but there's just not a whole ton of data to look into. Overall, with those factors, I'd say for the everyday investor, there's slightly above average risk in taking a look at this fund. The sixth fund we have on the list is the Global X SuperDividend ETF, or SDIV. The underlying index tracks the performance of 100 equally weighted companies that rank amongst the highest dividend yield equity securities in the world, which include emerging market countries. And a good number of companies in the fund, I would say, are mid-cap value. Looking at composition, we don't have top holdings because they're all equally weighted. However, looking at the list of companies, I don't recognize a good number of these names, probably because they are on the international sector. We'll then move on to average returns. This fund has a 10-year average return of negative 1.83%. Its dividend, however, pays out monthly, and its yield has been about 13.05%. The cost of this fund is getting up there at an expense ratio of 0.58%, meaning for every $10,000 invested, you're gonna pay a fee of $58. So what are the risks here? Well, one of the risks to consider is the fact that you are getting exposure to the emerging markets, which in of itself are not bad, but there's certainly more volatility involved. So I would say it's certainly above average. In addition, don't fall into the trap of chasing a high yield dividend. As you can see, the fund itself is at a negative 1% return over 10 years, even though it's paying a monthly dividend of 13%. So really, you have to be very tactical how you're gonna leverage this fund in your overall portfolio. And that is the end of the list, folks. I appreciate you all sticking with me. So if you've been commenting throughout, I'm sure you probably picked up something. As that dividend yield got higher, we generally saw that the returns either stagnated or honestly got worse, all the way to the point of SDIV actually giving you a negative return over 10 years. So the point I wanna make here is, yes, there are high dividend dividend ETFs in the marketplace. Yes, you can get a juicy dividend yield of over 10, 12%. However, the trade-off is going to be on the return of the value of that ultimate ETF. Now, JEPI might seem like it's an exception to the rule. However, if we look at its 1-year return, it's honestly closer to a little over 1%, even though since inception, it's closer towards 9%. So please drop your comments, questions, or concerns down below, and I will catch you all on the next video. Peace!